All right, Trump 2.0, it is officially live. And to say that the last 2.5 days has been anything but exciting would be a massive understatement, as the new president comes in with sweeping changes, a plethora of executive orders and major policy changes right out of the gate. And as much fun as it might be to talk politics, what I really care about is markets and what the impact of the changes that we've seen so far on markets are going to be. Just to set the stage, as of right now, markets just on the edge of all-time highs. This is the environment that Trump is kicking off into, and the big question is, as we finally get a sense of what his first priorities are going to be out of the gate, what can we make of it? What is the implication going to be on markets? Of course, really for going out almost 2 years straight, we have had a raging bull market that has effectively gone up and to the right nonstop. Will that continue? Won't it? That's what we're going to discuss tonight. So yeah, buckle up. It's going to be a good one. Probably one of the more important videos that I'm going to put out this entire year to kind of set the stage now that we know what to expect, or at least we got the first flavor of what to expect. So yeah, we're going to have a lot more to come. So if you are new here, make sure you get subscribed and turn that notification bell on so you can get notified. You're not going to want to miss what we have in store as Trump 2.0 takes off. Again, though, our focus here, markets, what are going to drive markets, how are policy decisions going to impact where markets are headed. And I think the best place to start is really just with the basics, like what drives markets, what has driven markets over the last, say, 5 years, and is the main driver going to continue? And if you've been around for a while, you know exactly where I'm going with this. And the primary driver of markets has been underlying fiscal flows. And the basis of this is, if you can just kind of put aside your policy, your politics, your economics, and whatever leaning you might have, at the heart of government spending, the end game of government spending in the world that is set up in the U.S., government spending is always adding financial assets to the private sector. So with that in mind, it is no surprise, and should be no surprise, that markets have been, for quite some time now, markets follow in lockstep underlying fiscal flows. Because if you think about it, if what kind of the MMT claim is true, that when the government spends, it's adding financial assets to the private sector, those financial assets, they've got to do something once they get into the private sector, no matter what. Even if the person that receives that, if they save those financial assets, those are going to be saved and eventually find themselves into the financial sector, which is just going to add buying pressure to assets. If they get spent, that means that the receiver of that is income, that's going to increase profits for the receiver of that, increase revenue, which in turn will increase the valuation of whatever entity is at the receiving end of that. So if you could just kind of put aside any sort of political, economic knee-jerk reaction you have and just follow the basic logic of it, it makes sense that what you're seeing on screen here, and pay attention to this purple line, it's the net flow moving average, the smoothed out moving average of the 90-day average. If you just follow that out, you have a very strong correlation between S&P returns and government spending. And that purple line is just the net flow of what the government is spending on average over time. And as flows slow down, so do markets. As flows accelerate, markets accelerate. And so the thing that we have to understand, that we have to determine, is where are these flows headed now that we are in Trump 2.0, now that we are in this new administration, and what are the executive orders that we've already seen? How are they going to impact? What does it look like Trump has on his agenda that are going to impact these flows? And that is the question that we have to ask. And as it stands right now, I'm moderately optimistic that flows aren't going to be impacted too much. So let's do this. Let's first point out the risks here. At this point, there are risks to flows. And the first is, As of right now, there was an executive order to go ahead and establish DOGE, which is the Department of Government Efficiency. This is Elon Musk's thing to cut spending, to kind of do the Malay thing that's happening in Argentina. That is established. That's a risk. When Elon Musk established this, it was the claim was $2 trillion of spending cuts that were going to happen. It seems impossible. There's just too much non-discretionary spending in the U.S. budget, so that's been pared back. I mean, at the end of the day, maybe he'll find $250 to $500 billion of non-discretionary spending that can get cut in the immediacy. But as of right now, despite this being established, Trump hasn't said much about it. Even in his post-inauguration speech, there was, just a very quick tip of the hat that this thing is being established, but there was no long, drawn-out explanation of how important it is that government spending get cut. Now, the next risk that is going to go ahead and be in effect immediately is Trump did, in signing a handful of the executive orders right after the inauguration, did kick off spending cuts in the sense that some of the tax cuts that are happening from the energy tax credits, those are going away. And based on my estimation and the research that I did, I think maybe up to about $100 to $200 billion worth of tax cuts have occurred because of those. So that is going to be, if you will, one spending cut, or at least a cut in government revenue or an increase in government revenue, given that those tax credits are no longer going to be there. The second thing that Trump has done as well is stop spending on many of the Biden initiatives, mainly I think the CHIPS Act itself and the infrastructure spending that came from that's going to be paused temporarily as that gets sorted out. And if I'm not mistaken, that was on the order of like nearly $300 billion in spending. I don't know how much of that has been spent out, but we have seen a handful of immediate pauses in spending, plus the establishment of DOGE, which do seem to be the biggest risks right now, initial spending and spending slowdowns that are already going to take place, at least with regards to the executive orders that shut down the Biden spending on infrastructure and then the tax credit. So that's going to be the negative hit. On the flip side, Trump also announced today the $500 billion investment that he's going to kick off with OpenAI and NVIDIA and Oracle to go ahead and accelerate AI research and development. So this was put out there, but just a few hours later, a top appointee to the Trump administration, Elon Musk, has come out and undermined this. So we'll wait and see if this spending is actually going to happen or if it's not. But at the very least, one sense that I'm certainly getting from the Trump administration is Trump, he wants grand, right? He wants big. And going back to the point I was making, at least the sense that I got from the post-inauguration speech, it didn't seem like this is a Donald Trump who is really gung-ho necessarily on actually getting spending cuts through. He certainly did not come off in any way to me as someone who sees that as some sort of existential threat. More so, again, I see it maybe just playing lip service to kind of the fiscal conservatives in government and those who voted for him. And already, I mean, the fact that he's coming out and saying, hey, look, I want to spend $500 billion on AI shows to me that he at least has an understanding that if he's going to really make kind of positive moves in the economy, that's going to come from government investing into the private sector. So, add that to the category of maybe not so fast that the spending cuts are going to have a tremendous negative impact. Also, on that front, in terms of what spending is going to look like, look, a lot of the spending that comes out of the government is non-discretionary, Social Security, healthcare, those sort of things. It's going to be very hard to stop that sort of spending and have any political goodwill left over if you cut that spending. So I would expect that sort of spending to continue on as well. And then you also have, and this is what the vast majority of kind of macro gurus and prognosticators are missing. You have really what has been one of the main drivers over the last 2 years, which is the interest income from higher interest rates. And as of right now, I'm going to go ahead and pull up the Fed Watch tool, the CME Fed Watch tool, to get a sense of kind of where our rates headed as we head into 2025, or at least the expectation of where rates are headed. And as it stands right now, I mean, it seems like the consensus is right around 50 to 75 basis points. I have December 2025 pulled up here to show you what the odds are of where that's going to land. Anywhere between 50 in 75 basis points seems to be what market expectations are. And so I don't see a dramatic drop. I mean, certainly this will put a little bit of a drag on that interest income if we do start seeing cuts. But as it stands right now, nothing dramatic. Expectations have certainly been dampening in terms of cuts. And so that interest income I expect to continue to remain moderately supportive at this time. And I really think too, by the middle of say 2025, we could end up seeing a scenario play out where maybe even the Fed has to start signaling once again that in fact rate hikes need to actually take hold. So look, there is some negative, there is some positive here in terms of those underlying flows and where those underlying flows are headed. But it is still a bit of a toss-up. I mean, we're gonna have to just kind of wait and see what ends up winning out. And the good news is, at this point in time, the good news is markets are not in any way, shape, or form aware of what the impact is of these flows. So it's not like we have to guess correctly everything that the Trump administration is going to do. We can wait, see how these flows ultimately end up coming in, and then making the necessary adjustments to our kind of macro compass when those flows finally come out. But I will say that, look, we want to be following flows closely. They are absolutely the first cause of the economic cycle. And while we are definitely in a new burgeoning era of likely credit cycle and kind of credit bubble that will eventually emerge. At this point, the fiscal flows, as they hit the private sector, they're going to continue to bid up asset prices, and that trend would absolutely continue as long as those flows are coming in. And then, of course, if they do stop, then we need to adjust. We need to understand what that world looks like and what the impact is going to be. But as of right now, that's where we stand in terms of kind of what expectations are. And as I see it, I would expect flows to remain fairly strong as we head into early 2025. And then the big kind of inflection point that we're going to want to keep an eye on is going to be tax season as April rolls along, and then we'll reassess at that point. But in the meantime, keep an eye on those flows. And of course, you can always follow those flows over at Applied MMT. Sign up for a pro account. If you're an active trader, active investor, we have a plethora of tools, models available on the website, and access to the weekly updates that I post there. Again, active traders, active investors, head on over to appliedmmt.com. Otherwise, that is what we have for tonight. So until next time, good trading, everyone, and we'll talk to you then. Bye-bye.